In today's video, we're going to talk about how to buy life insurance without getting ripped off. So we're going to talk about the 5 major reasons why you might get ripped off when you're buying life insurance and how to avoid them. And by the way, number 5 is the most important thing to make sure that you don't do and make sure you're not getting ripped off for life insurance. So make sure you stick around till point number 5 to find that one out. What's up, guys? My name is Philip Setter, and if you don't know me, I'm the founder and CEO of Affinity Life, which is an online life insurance platform here in Canada where you can actually view quotes 100% online and apply 100% online as well. If that sounds interesting to you, I'll put the link in the description below. But without further ado, let's get right into the video. So before we get into the 5 reasons about why you might get ripped off trying to buy life insurance here in Canada, let me just give you a quick rundown of exactly how life insurance works here in Canada. So we have 2 major types of life insurance here in Canada. We have term life insurance and permanent life insurance. Now, with permanent life insurance, there's 2 different options. You have whole life and you have universal life, and term life insurance is just term life insurance. That's relatively easy to understand. Now, a quick synopsis of term versus permanent. Term is really meant to cover you for a very specific period of time. In my opinion, I think it's the best and most affordable option for most Canadians. It's really meant to cover you for, when you need it the most, when you're maybe in your 30s, your 40s, or your 50s, and your family is growing up, you have kids in the house, maybe you have a mortgage, you have car payments, you have debt. If you were to pass away, your loved ones would have a large financial crater that's in their life, and they would be, during this time of grieving, very financially stressed. And really the point of life insurance is just to take away that one less overwhelming stress. It's never going to bring back your loved ones, but it will let them grieve without this one overwhelming stress of how am I going to pay my mortgage? How am I going to pay the debt? How are we going to keep the kids in this school? How am I going to be able to afford all this? How do I get, daycare or a nanny to take care of the kids while I'll go to work? They don't have to think about that if something were to happen to you. It's really just to take care of that one overwhelming stress. And term life insurance is the most affordable way to achieve that. It's used to cover you for a specific period of time. You can pick a duration that you'd like. So maybe a term 10, a term 20, or a term 30. And it's relatively the most inexpensive option. It's incredibly affordable. And again, if you wanted to check term life insurance rates, just go to affinitylife.ca. You can instantly view them without having to put in any information besides, your date of birth and gender and smoking status, but you don't have to connect with an advisor or anything like that. Instant quotes online. Do check that out if you are looking for rates, but that's what term life insurance is for. It's just meant to cover you for that specific period of time. Now, permanent life insurance, on the other hand, is not a what if, it's a when. So with term life insurance, it's what if something happened. With permanent life insurance, it's when is it going to happen. Permanent life insurance is meant to cover you all the way until the end, until death. So this is really used for passing something down to the next generation. Maybe your kids, maybe your grandkids, maybe you want to leave something behind to a charity that's important to you, or maybe you want to start looking at estate planning. Maybe you have a large estate, maybe you have other homes, maybe you have other investments or things that you want to pass down, and you're looking at taxes upon death, funeral expenses, and other estate planning goals. Permanent life insurance is a really good option for that. All right, but let's talk about the 5 things that you need to know so you can buy life insurance without getting ripped off. So number 1 is use a broker channel. So let me explain a little bit how life insurance companies work here in Canada. We have about maybe 30 to 40 different life insurance companies from all different areas. There's some major ones out there that you guys are probably familiar with: Sun Life, RBC, Equitable, BMO Insurance. These are pretty common ones. The way that it works is about 90% of those companies operate through what's known as a broker channel. So 90% of those companies will not sell directly to the consumer. If you actually reach out to those companies, they'll say, yeah, we can help you with some insurance, and they'll actually refer you to a broker. They will not sell directly to an individual. So how this works is you would work with a broker who then has access to these, 90% of the companies in Canada, and they would say, okay, well, based upon your age, your smoking status, your gender, your health style, your lifestyle decisions, and other factors, let's shop the market and find which company would be best for you. And so, of course, there's, a few of them that kind of surface to the top, but for the most part, you're going to want to search across all the companies in Canada to make sure that you're not only getting best rate for your specific circumstance, but you're also getting maybe the best company that you're most interested in. Now, the other 10% of companies in Canada do not go through that broker channel. So they're what you would be called a captive captive company. Okay, so either A, they're a captive company, or B, they're a direct to consumer model. So how this works with a captive company is you would have agents that work for this one specific company, but that's all that they work for, right? So when you go in and you say, hey, could I get some insurance quotes for, I'm male or female, 20, 30 years old, non-smoker, yada, yada. They say, no problem. And they go and they look at their one specific company that they work with, and they find their one product that they offer you. And maybe that's the good product for you. Maybe that's the best product, but maybe it's not the best product. Maybe you need to shop the market and figure out, okay, this rate band is best in this company. This rate band is best in this company. And you're not going to find out any of that information from dealing with one company. So I would say 9 times out of 10, you're probably not going to get the best options or the best rates if you work with a captive insurance company. So number one, you want to make sure that you're working with a broker that can source multiple different companies so you can compare and say, okay, well, why is this one more expensive? What about this one? What about this one? Okay, I like that one. Let's pick that one. Number 2, buy life insurance on the lives of family members and individuals whose income or service is needed. So, in a family, let's just talk about that for a sec. We have a husband, we have a wife usually, and we have kids in some circumstances. Well, in that, you're going to have breadwinners of the family. You're going to have people that take care of the children. Well, if there's an individual in the family that's making the income that's supporting the family, that's a life that we need to insure, because if that individual were to pass away, the family would be obviously in a lot of financial stress and they wouldn't be able to take care of the family anymore. Furthermore, the individual that's maybe staying at home with the children, taking care of the children, this isn't necessarily an income that we're now replacing. However, it is a service that we're now replacing. So there is a common question, well, should I get life insurance on my stay-at-home spouse? I would say 100% absolutely yes. There's maybe not necessarily an income that they're bringing to the household. There may be some type of part-time gig or some type of part-time job that they are bringing in income, in which case you should insure that. However, it's really the service that you're insuring. You're insuring, well, what would happen if they were to pass away and I then had to not only work at my job, but now take care of the children? This is where you need to think about, okay, what would that would cost? I would need daycare. I might need nanny services. I might need someone to help me prepare meals. I might need someone to clean the house. All of these services are going to add up, and it could be anywhere from $30,000 to $60,000 a year, depending on your circumstances. So ensuring that individual is very important. Now, let's talk about the children in the family. So this question comes up quite a bit. Should I buy life insurance on my children? And my answer is no. Whose income or service are we replacing? Yes, if a child was to unfortunately pass away, that would be a terrible situation. You would be absolutely in devastation and grief because they passed away, but you would not be financially burdened by them passing away. There's no income that they're bringing into the household or service that they're really bringing into the household. So my opinion is no, you do not need to buy life insurance on your children. If somebody's telling you that you should buy life insurance on your children, I would say that that's not a good idea. And I would really ask them why they think that your children need life insurance. And by the way, I am going to make another video on this that really breaks into the nitty-gritty about my opinion on this. If you're interested in that, just drop a comment below asking for that video, and hopefully by this time it will be done and I will give it to you guys. But in my opinion, that's not a great idea, and it's just a waste of money and an easy way for you to get ripped off. Number 3, buy the right term of life insurance for the right duration. So here's the thing, okay? When planning to buy life insurance, I think a lot of people get into a little bit of an analysis paralysis. And so they look and they say, okay, well, do I need it for 10 years? Do I need it for 20 years? Do I need it for 30 years? Do I need 100,000? Do I need 500,000? Do I need $1 million? What if my income changes? What if I get a house? What if I have more debt? What if I have less debt? What if I pay this down? What if I do this? Listen, let me tell you something from personal experience. Some life insurance will be vastly better than nothing. Some small amount will be vastly better than just doing absolutely nothing and have nothing in place because you went through this analysis paralysis and you never made a decision. So at the end of the day, the way that term life insurance works is the shorter the term, the less expensive it is. The longer the term, the more expensive it is. The less coverage you have, the less expensive. The more coverage you have, the more expensive. So when you're designing a policy that fits your needs, stop trying to figure out all the variables and everything that you need to know, and just pick on something that you can realistically afford, and that you're not going to look going through your bank account every month and be like, oh my gosh, how am I going to pay for this? You want to look at that payment coming out and be like, no problem. That doesn't stress me out in the slightest. If you're looking at an amount that's just like eye-watering and staggering, and you see it every month and you get this twinge in your chest and you're thinking, oh my God, how am I going to pay for this? That's too much life insurance. I'm telling you right now, if you can't afford it, if you need, let's say 2-3 million, but you can only afford 1 million, then that's what you need to get. You need to pick a coverage amount and term length that is not only makes sense for you, but it also is comfortable within your budget. That's most important. And down the road, you can add more policies. This isn't like a set it once and it's done forever. Let's say that later on down the road, your income increases, you pay off some things, you have a little bit more money, and you want to bump that coverage up, you can then just get another policy. So it's not like it's this buy it once, set it forever, and forget about it. You can buy a 10-year term policy, and then maybe 8 years later, you buy another 10-year, and then maybe you decide you want to cancel the previous one, or maybe you want to add to it. So it's not like it's this static thing that's fixed for the rest of your life. It can be this dynamic, growing life insurance policy that as your needs change, you then revisit it and change exactly what it is. Number 4 is getting the right coverage amount. And I did kind of talk about that in the previous point here. However, again, I mean, you want to get what you can afford, but as a general rule of thumb, you want to get, let's say, 5 to 10 times your annual salary plus your outstanding debt minus any savings and other investments and other life insurance that you may have. But one of the ways that you can get ripped off is just by buying too much life insurance. You know, maybe you looked at it and it looks really good. It feels like, okay, this is not a bad option. Maybe you buy way too much coverage. You're buying $4 or $5 million of coverage, and your family just doesn't simply need that. Here's the thing. Life insurance isn't a lottery. It's not meant to, financially set your family up for the rest of their lives. It's not meant to, so they can go out and buy a mansion and, get a Ferrari and a Lamborghini and all these other things. That's not what life insurance is meant for. Life insurance is really meant to just help offset those costs and help bring the income that you previously brought back into the family and help them get back on their feet over the next 3 to 5 year, 3 to 10 year period. It's not meant to set them up for life and have them be financially set and never have to work another day in their life. That's not what it's meant for. It's meant to just help them during that period of time and get set up, whatever it is, with maybe they have kids, maybe you have outstanding mortgage, maybe you have some other debt. Let's get that taken care of. But it's not meant to set them up and then have them never work another day in their life. Number 5, the most important thing you need to watch out for, and in my opinion, the biggest way that you will get ripped off buying life insurance in Canada is buying life insurance as an investment. So let's get into it. So here's the thing, okay? Many advisors in Canada, many advisors will pitch the idea that you should, instead of buying term and wasting your money, you should buy permanent life insurance, because not only does it last until the end and it covers you during the specific period of time, but also you're going to have this investment component that you can use during your retirement, and you can supplement your retirement income from it and pull from it, and et cetera, okay? All right, let's talk about it. Permanent life insurance, when you're buying it as an investment, not only is it significantly more expensive than term life insurance, and I'm talking in the multitude of 4 to 20 times more expensive than term life insurance, when used as a strategy as an investment, is incredibly complicated. There's so many things that can go wrong with this strategy. It depends on so many different variables. Is it whole life that you're buying, or is it universal life? I literally just talked to another advisor yesterday who said he had a client come in that had been putting $50,000 away every single year for 10 years. He put $500,000 into a permanent life insurance policy as an investment that he thought at the end he would be able to stop paying the premiums on and then use it as an investment. In year 12, he got a notice saying that not only did he not have enough money to fund the policy, but he needed to now contribute more money into the policy to fund it. This guy is now $500,000 into this strategy, and they're asking him to put more money into the strategy. So I made another lengthy video about exactly how this strategy works and the pitfalls of it. And I compared it apples to apples to a very traditional RRSP strategy. You put it into an RRSP, your investment grows tax deferred. It's a very simple strategy. It's easy to understand. The government's already created this tax sheltered account. There's no strings attached, and there's no additional complexities that really make this plan fall apart. I compared it apples to that. If you're interested in that video, just put a comment below and I will send it to you, and you can then compare it apples to apples. So when does this strategy ever make sense? Well, I would say for the minority of Canadians that are either high income earners from maybe their job, maybe they're a CEO, or they're business owners that have a lot of excess cash within their corporation, and they've already maxed out their RRSP, they've already maxed out their TFSA, and they've already maybe paid off all of their high interest debt, such as credit cards and other outstanding debt, then yeah, this could be a very good idea. And so if you fall in that bracket, absolutely, this is maybe a good option for you. However, if you're like the majority of Canadians that haven't maxed out their RRSP, they haven't maxed out their TFSA, and they still have outstanding high interest credit card debt or other types of debt, such as maybe a line of credit, then I would say this is not a good idea and a really easy way for you to get ripped off. So I hope that answered a lot of your questions about how to buy life insurance in Canada without getting ripped off. If you guys have any questions or comments, just put them down below. And if you guys are enjoying this content, all I ask is that you give it a thumbs up, and I'll see you guys in the next one.